Silver just sent a warning shot that most people will only recognize after the next spike makes it obvious, and the strange part is the headline, price, isn't even the loudest signal. The loudest signal is the tension underneath it, the kind that shows up when paper liquidity says calm, while the real-world metal says good luck finding it fast. And there is the reason the mainstream commentary keeps circling the same tired explanations. Because if you focus on a simple narrative, you miss the mechanism that's building pressure right now. Stay with me, because by the end, you'll have a clean, concrete checklist for the next week or two: what level matters, what confirms the setup, what breaks it, and the one hidden metric that usually moves first. Now, here's the conflict. Silver is a market that rewards people who understand structure and punishes people who react to noise. There are forces, funds, dealers, even well-meaning commentators who benefit when you experience the move as chaos, because chaos creates churn, churn creates liquidity for someone else, and liquidity is how positions get built without paying up. And silver, more than most assets, is where that game gets played in public. It whips, it fakes you out. It gives you a clean breakout and then snaps back like it's laughing. That's not an accident of emotion. That's how a thin, leveraged, dual-purpose metal behaves when futures, options hedging, and physical procurement all tug on the same rope. And right now, that rope just got tighter. What just changed is not that people like silver again. What just changed is the demand mix, and the demand mix changes the power dynamic. When demand is mostly speculative, it can vanish with one ugly macro print. When demand is increasingly industrial and procurement-driven, it doesn't vanish. It gets deferred, rationed, hedged, and pulled forward. It becomes sticky. And sticky demand is how you get the kind of persistent pressure that keeps showing up even after sell-offs, the kind that makes dips feel like they were being vacuumed up quicker than you would expect. That's where the real pressure starts. Think about silver the way the supply chain sees it, not the way a chart sees it. A chart shows a line. A supply chain shows lead times, fabrication capacity, inventory categories, and where metal is physically located. Silver is not just a store of value cousin to gold, it's a working metal. Solar, electronics, medical, chemical catalysts, industrial alloys, plus the investment narrative that can surge in waves. That dual identity is exactly why it can go from sleepy to violent. In the last stretches of price action, you've likely felt it. Sharp pushes, sudden pullbacks, then another shove. That pattern isn't random. That's what happens when positioning gets crowded on one side and hedging has to chase price on the other, while physical users quietly refuse to step away. But that isn't the part that matters. The part that matters is what those moves are doing to the internal plumbing of the market. Here's the hidden detail that reframes the entire story. In silver, the spot quote can lie to you for longer than you think, but the spreads start confessing early. When people talk about silver demand, they often point to one simple thing: price going up, and then they stop. That's lazy. The real signal is whether the market is paying you to hold inventory or charging you to source it. That shows up in term structure, lease, borrowing dynamics, and the tug of war between deliverable and non-deliverable inventory. In a healthy, well-supplied market, you usually see the curve behave politely. Forward prices slightly above spot because carrying metal costs money, financing, insurance, storage. In a stressed market, you can see the opposite behavior. Tightness that makes nearby metal more valuable than later metal, or at least tightness that collapses the carry. And when that happens, it's not a philosophical debate. It forces participants to act. Dealers adjust quotes, fabricators pull forward orders, arbitrageurs look for metal in other regions. Shorts, who were comfortable rolling positions, suddenly have to think about whether they can keep rolling at the same cost. And options market makers, who don't get to have an opinion, are forced to hedge more aggressively as price moves. Because if this one level breaks, the math changes. Let's translate that mechanism without turning it into a textbook. The silver market has two big worlds that touch each other: the paper world and the physical world. The paper world, futures, options, OTC derivatives, can expand instantly. Contracts can be created, positions can be opened, and exposure can be flipped with a click. The physical world cannot expand instantly. Mining output can't jump this month because price moved this week. Refining and fabrication can't be scaled overnight. Scrap recycling responds, but it has limits and lag. And crucially, the physical metal you need has to be in the right form and the right place at the right time. So when demand changes fast, the stress shows up not as a magical shortage headline, but as friction. Higher premiums in certain channels, longer lead times, harder sourcing, and a market structure that starts behaving tight. That is the line where the paper market stops being the whole story and starts being a proxy for a physical reality. It can fully control. And that's where the warning in silver demand is coming from right now. Now stack the proof, because one argument is never enough in a market this noisy. First proof point: the structural demand story is not hypothetical. The industrial side of silver demand has been hitting new highs in recent years, driven especially by electrification and solar deployment, plus broad electronics demand that doesn't care about your macro narrative in the way investors do. When industrial demand grows, it doesn't just add a little buying. It changes inventory behavior. Industrial users don't buy because they think price will go up. They buy because they need metal to ship product. That means even when price spikes and they try to stretch inventories, they still need coverage. They may hedge instead of immediately buying physical. They may switch suppliers. They may accept higher premiums, but the baseline pull stays. And that baseline pull is the difference between a rally that fades and a rally that keeps finding buyers. Second proof point, silver supply is not a clean, responsive lever. A large chunk of silver production is byproduct, tied to the economics of mining other metals. That matters because it means you can just say higher silver price equals higher silver supply next quarter. If base metal economics are soft, you don't get a surge of silver even if silver is hot. Meanwhile, new primary projects take years, not months. And permitting, financing, and capex cycles don't accelerate just because retail sentiment got excited. That creates a quiet constraint that doesn't show up on a one-day chart, but it shows up in how quickly physical tightness can develop when demand leans in. Third proof point, inventories are not one number. The category matters. People throw around the word inventory like it's a single bucket. It isn't. In exchange systems, you have deliverable categories versus not immediately deliverable. You have metal that is registered for delivery and metal that is simply sitting in a vault but not pledged to satisfy contracts. You have metal in the right bar size and brand and location, and metal that exists but would take time and cost to convert. In London, you have large pools of vaulted metal tied into the wholesale system, and shifts there can hint at whether liquidity is improving or tightening. When silver gets tight, what disappears first is not the metal itself. It is the willingness to part with the metal in the form and timing the market demands. That says to us why the stress often shows up as availability and borrow cost die before it shows up as an empty warehouse. The next detail is what flips the whole setup. Fourth proof point, global arbitrage and regional premiums. Silver is not one global pool with one uniform price. There's a benchmark quote, and then there's the real transaction world across regions, products, and delivery conditions. When demand surges in one region, whether from industrial procurement, retail bar, coin buying, or fabrication demand, you can see premiums widen. You can see metal flow from one region to another when it's profitable. But those flows aren't instant because logistics, financing, and fabrication bottlenecks slow the transfer. That S, where the price is lying per their own frame, becomes real. The benchmark can look calm while the real-world sourcing cost is screaming. And when arbitrage finally bites, it can pull price abruptly because arbitrageurs and dealers don't ease into it. They respond when the spread pays them enough to move size. Fifth proof point, options reflexivity, the silent accelerant. In the short run, especially around key calendar windows, options can drive price in a way that looks like mystery momentum. Here's what's happening under the hood. Market makers who sell options to the public and to funds typically hedge their exposure in the underlying. When price rises, the delta of certain call options increases, meaning the market maker's hedge requirement increases. They may need to buy more futures to stay neutral. If positioning is set up such that there's a lot of open interest clustered around certain strikes, you can get a reflexive loop. Price rises into a zone, hedging demand increases, that buying pushes price further, which increases hedge requirements again. That's how you get those sudden, breathless bursts that feel like silver teleports. And in thin liquidity, late week sessions, holiday adjacent sessions, month-end windows, that effect is stronger. Because the book is thinner, the same forced buying moves price more. But that's not a free lunch. The same reflexivity works in reverse on pullbacks, and that's why people get emotionally wrecked trying to trade every wiggle. Volatility is where weak hands are manufactured. Now we hit the why now, because timing is everything. The calendar matters in metals in a way that most people ignore until it bites them. Late month flows, option expiries, futures roll periods, delivery windows. These are not trivia. They're catalysts because they compress decisions. They force dealers to rebalance inventories. They force funds to roll exposure or take delivery risk seriously. They force hedgers to adjust when gamma changes. And they create moments where liquidity thins at exactly the wrong time. Right now, the setup has that flavor. A market that's been climbing, a crowd that's starting to notice, and a calendar window that can turn gradual into gap. That's why the warning feels urgent this week and this month. Because the next move often happens when the market is least prepared to absorb it. And the people who get punished are the ones who assume the line on the screen is the entire story. Here's what that means in practical terms. If silver is trading in the upper 20s to low 30s range, or pushing toward a big round number zone, the levels that matter are not a single penny price. They're zones where behavior changes. A psychologically important round number often acts like a magnet and a trap at the same time. Price approaches it, liquidity thins, option strikes cluster, and suddenly you see a burst above followed by a snapback. That snapback is not automatically bearish. Sometimes it's simply the market forcing late buyers to puke so bigger players can reload. But sometimes it's the start of a deeper mean reversion. So you need a two-scenario lens that keeps you honest. Scenario 1 is the controlled pullback and retest. In this path, silver cools off, gives back part of the recent push, and retests a prior breakout zone, often somewhere a few percent below the highs. The confirmation for this scenario is not price goes down, it's how it goes down. Does it drift lower on lower volume and calmer tape, with dips getting bought quickly? Do the sell-offs fail to accelerate? Does the market find support near a prior pivot and then reclaim it without drama? In this scenario, the warning shot remains valid because the structure holds. It's just letting the market breathe. Scenario 2 is the continuation squeeze. In this path, silver doesn't give you the polite retest. It grinds, then pops, then gaps, often on a session where you'd least expect fireworks. Late Friday, early Monday, or a thin liquidity pocket. The confirmation here is not just higher highs. It's a change in character, faster moves, shallow pullbacks, and a feeling that offers are being pulled rather than hit. That's the signature of forced buying. Shorts covering, hedgers chasing, and market makers buying to hedge. But here's the warning. This scenario is also where gap risk lives. If you're chasing, you can get trapped at the worst possible moment, and that's exactly how volatility is used against you. This is the psychological shield you need because silver will try to turn your brain into a bad risk manager. The market will tempt you into two classic mistakes. Panic buying at the top of a burst because you feel like you're remissing a once-in-a-decade move, or panic selling at the bottom of a flush because you feel like the story was fake. Both mistakes come from treating noise as signal. Here's the mental model that keeps you sane. Trend signal is structure and follow-through. Noise is intraday violence around known liquidity and option zones. If the thesis is correct, price can still whip around violently. In fact, it often must whip around because the market's job is not to reward your confidence, it's to test it. It will run stops, it will fake breakdowns, it will stage sharp rallies that feel like the real move, then yank back to see who's levered. If you don't expect that, you'll interpret normal silver behavior as proof you were wrong, right before the actual move resumes. The way you avoid that trap is by anchoring to invalidation and confirmation, not emotions. Decide what breaks the thesis. Decide what confirms it. Then let the tape do what it does. Because the next detail is what people miss. In metals, the story can be right and your timing can still be wrong. That's not a contradiction, that's reality. So what are the confirmation signals you can actually watch without needing secret data? Start with term structure behavior. You don't need to be a professional spread trader to respect it. If nearby pricing stays firm relative to forward pricing during pullbacks, that suggests tightness and urgency in near-term supply. If the curve steepens into contango while price struggles, that suggests easing tightness and more comfortable carry conditions. Next, watch the behavior around major strikes and round number zones. If price repeatedly tries to push through a big zone and keeps getting rejected with hard sell-offs that persist for days, that's different from quick rejection followed by fast recovery. One is distribution, the other is absorption. Next, watch the relationship between silver and gold. If silver begins to outperform persistently, that often signals an industrial demand tailwind and a risk on metal bid, but it can also be a sign of speculative froth. The so what is simple. If silver is leading and holding, it often pulls attention and flows. If it's leading but failing, it can be a warning that leverage is getting ahead of itself. Next, watch the dollar and real rates as the macro backdrop. Silver doesn't exist in a vacuum. A stronger dollar and rising real yields can create headwinds by tightening financial conditions and strengthening the opportunity cost narrative. But here, amongst the nuance, silver can rise even in that environment if physical tightness and industrial demand are strong enough. When that happens, it is a tell that the metal is trading on something more fundamental than a simple macro correlation. That's a clue, not a guarantee, but it's a clue worth respecting. Next, watch the street symptoms: premiums, retail availability chatter, delivery lead times. You don't need exact numbers to notice direction. When you hear consistent reports that certain products are harder to source quickly, or premiums are not relaxing even when price pulls back, that's another layer of proof that demand is not purely speculative. It's sticky. And sticky demand is how paper pricing eventually gets dragged toward physical reality. Now let's handle the counterpoints, because trust comes from acknowledging what could go wrong. There are two big ways this setup could cool without the world ending. One, supply chain normalization and metal remobilization. If higher prices coax out scrap supply, If holders become willing sellers, if inventories that were parked get reintroduced into the market, tightness can ease, spreads can relax, the curve can normalize. That doesn't mean the long-term story is dead. It means the near-term squeeze pressure is relieved. 2, a macro shock that hits industrial demand expectations. If growth fears spike, if manufacturing indicators weaken sharply, if policy signals change in a way that threatens the pace of electrification deployment, the market can reprice forward demand assumptions. Silver can sell off hard in that scenario because it's still a leveraged, sentiment-sensitive market on the paper side. And if that kind of shock happens during a crowded positioning moment, the unwind can be brutal. That's why you don't treat the thesis as a guarantee. You treat it as a probabilistic setup with clear invalidation. So what would actually invalidate the warning signal in a clean, observable way? It would look like this. Repeated failures at key resistance zones, followed by lower lows that Don T recover quickly, accompanied by easing in the tightness signals. Spreads relaxing near-term urgency disappearing, and dips no longer getting bought with the same aggression. It would also look like a change in character, where rallies become labored and sell-offs become effortless. That is the market telling you the demand mix isn't T-dominating supply in the short run anymore. It might still be a story for later, but the immediate warning would have passed. On the other hand, what confirms the warning and keeps it alive into the next couple of weeks? A controlled pullback that holds above a prior breakout zone and then reclaims momentum. Or a continuation move that breaks a major psychological number and, crucially, holds above it on a closing basis rather than just spiking. That close detail matters because it's where funds and systematic strategies often make decisions, and it's where hedging books get recalibrated. The market can poke above a number for 10 minutes and still be a trap. A sustained hold changes who is forced to act. And that's the entire game, forcing. Forced buying is different from voluntary buying. Voluntary buying is patient. Forced buying is urgent. Forced buying doesn't wait for your pullback. It pays up. And when forced buying meets a market with limited immediate physical flexibility, you get air pockets on the way up and trapdoors on the way down. That's silver. That's why the warning is clear. Now bring it home with a near-term roadmap you can actually use. Over the next week or two, treat the market like it's sitting on a spring. Your job is not to guess the exact tick. Your job is to watch the pressure points. First, identify the nearest obvious support zone that price defended recently, the kind of area where pullback stopped and buying returned. If silver pulls into that zone and stabilizes, that's scenario 1 behavior. If it slices through it and doesn't snap back, that's a yellow flag. Second, identify the nearest major resistance or psychological zone above, often a round number where headlines cluster and option strikes concentrate. If silver approaches that zone and you see repeated rejections, watch how quickly it recovers. Fast recovery suggests absorption. Slow recovery suggests distribution. Third, watch for calendar-induced volatility spikes. If you get a sudden move during thin liquidity, don't immediately treat it as truth. Treat it as a stress test. Does the market keep the move, or does it fade it? The answer tells you whether the move was driven by forced flows that persist or by a one-off liquidity vacuum that reverses. Fourth, keep an eye on cross-market confirmation. If gold is firm and silver is firm, that's a supportive macro metal backdrop. If gold is flat and silver is surging, that can be fine. But it can also mean the move is more flow-driven and potentially more fragile. If gold is breaking down and silver is trying to rally alone, that's where you tighten your skepticism and demand better confirmation from structure and spreads. Fifth, don't ignore the simple behavioral tell, how people talk about silver when it pulls back. If the narrative instantly flips from inevitable breakout to dead trade on a normal pullback, that's a sign the crowd is emotionally unprepared, which often means the positioning shakeout isn't done yet. That emotional instability is fuel, but it's also danger for anyone without a plan. Because if you let the market steer your emotions, you'll become liquidity for someone with a plan. And that's the real warning silver demand sends, not just about price, but about participation. A market where demand is shifting towards stickier industrial pull and tighter supply flexibility is a market where the tape will increasingly punish impulsive behavior. It will reward structure, patience, and clarity. It will also create moments where the move happens faster than the average person believes is reasonable, because the average person thinks in stories and the market is moving on math. One last thing, the quiet revelation that ties all of this together, the benchmark quote is what everyone stares at, but the stress shows up first where the market can T-hide it, in the cost and urgency of getting metal where it needs to be. The price can be managed by liquidity for a while. The spread and the sourcing pressure are harder to fake for long. If you want one metric to obsess over, not in a conspiracy way, in a market structure way, obsess over whether tightness signals keep reappearing after pullbacks. That's the clue that demand is not just visiting. It's moving in. And if that continues through the next calendar window, the odds shift toward a move that won't politely wait for everyone to feel comfortable. That's where the real pressure starts. So if you're building your view right now, keep it simple and disciplined. 2 scenarios, clear levels, trend versus noise, and a checklist that doesn't care about your feelings. If the market gives you the controlled pullback and retest, you watch for stability and reclaim. If the market gives you the continuation squeeze, you respect the gap risk and don't let FOMO force your hand. And through both scenarios, you remember the paradox that keeps you safe. Even if the thesis is right, silver can still whip you around. Your edge is not bravado. Your edge is structure. If you're still here, you brought the kind of person who doesn't need permission from a headline to track pressure, and that's rare. Stay anchored, stay skeptical, and stay alert to the hidden signal beneath the quote. Because when that signal turns, it turns before the crowd notices.